How much home can you afford to purchase if you make between $50,000 and $100,000 of income, putting just 3.5% down using an FHA loan? Now, some of you watching this may think that you've seen this video before, and I've actually filmed a similar video before, but interest rates were quite a bit higher than where they are today. In fact, interest rates are at the lowest point when I've ever started doing these videos, which in comparison means you're going to be able to afford more house using today's interest rates than when I previously shot this video. So if you've seen it before, make sure you stay tuned to see exactly how much you can afford to purchase. Now you might be asking, Jeb, why are we using an FHA loan versus say a conventional loan or a USDA loan? And the primary reason we're using FHA is because FHA is the most lenient loan program out there when it comes to financing outside of VA. And VA, you have to be qualified, you have to be a veteran or someone that served in the military in order to use VA, so that's not an option. So with that, FHA is the most lenient program that anyone can qualify for. Even if you're a veteran, you can use FHA. And the primary reason it's so lenient is because they allow you to use more of your monthly debt towards qualifying than any other loan program. You can actually go as high as a 57% debt to income ratio on the back end when using FHA, where most other loan programs are going to cap you out at around 50%. And all that means for you as a borrower is that you can have more monthly debt and still qualify for more home using FHA than you can with conventional, than you can with USDA, than you can with really any other loan program out there. In addition to that, FHA allows lower credit scores. In fact, you can buy a home using an FHA loan with credit scores as low as 500 as long as you have at least 10% down. And with that said, if your credit score is between 500 and 580, you're going to need at least 10% down using an FHA loan. But if you have a 580 or better credit score, you can use FHA with just 3.5% down and buy a house. But something I want to make you very, very aware of and very transparent in this video. A lot of lenders out there don't do 580 credit scores with FHA. Even though FHA allows it, a lot of lenders out there put their own overlays on these programs, which essentially means they have their own guidelines on top of FHA's guidelines that require higher credit scores. So don't be surprised if you walk into a bank or you talk to someone online and they say, you've just got a 580, you don't actually qualify for FHA. And that can be because of a number of factors. It can be the overlays on the program. It can be some other factors with your credit profile that are just keeping you out of being able to qualify, like your debt to income ratio, which we're going to talk about in more detail here in just a minute. Or it could be something else. So just make sure when you're out there trying to get pre-approved to buy a home using any type of loan program, just make sure you're working with a professional, someone that understands what they're doing, someone that can guide you through that process, someone that can tell you why you're not qualifying, or maybe tell you what you can do in order to help you qualify. Now, in addition to the down payment requirement and the credit score requirement, FHA has some other additional requirements when it comes to buying a home. Now, I'm not going to go through a lot of that in today's video, but I will link to it at the end of this video if you want to see all of the guidelines that you need to meet in order to qualify for an FHA loan. And the other thing I want to point out is this video is for novelty purposes only. Don't watch this video and think, hey, I'm going to use an FHA loan. I have to use an FHA loan. I'm not even going to consider a conventional, or I would never use an FHA loan because of this or that. Make sure you talk to a lender, have them do a side-by-side comparison when they're talking about FHA versus a conventional or whatever you qualify for. Just have them lay it out so that you have everything side by side and you can make an informed decision. We've had clients in the past that said, I would never use FHA, and they end up going FHA. And then we have people that say, I have to use FHA, and they end up going conventional. So just make sure your lender shows you a comparison, assuming you qualify, so that you know all of your options. Now, if you're watching this, you don't know who to call, you don't know where to start, you can actually work directly with my team and I. We help a lot of people just like you here on YouTube, first-time homebuyers going through the process. If you want to get in touch with us, there's a referral link below on the screen as well as in the description of this video. Now with that, I want to get to the main reason why you're here, and that's determining how much you can purchase based on your income, whether you make $50,000, $75,000, or $100,000 of income. Now, in the past, when I've done this video, I've done 50 to 75, and that seems to be the sweet spot for a lot of people. But I thought I would throw $100,000 of income in there as well, because people are always making a little bit more money, always trying to climb up the ladder, if you will. So if you're at that 75 and you're trying to get to 100, you'll know exactly where you stand. On top of that, I feel like there's two things that you have to understand when calculating housing payments using FHA. With FHA, there's something called mortgage insurance, which is added onto your monthly payment every single month because FHA requires it, regardless of how much money you put down. Now, for conventional loans, mortgage insurance actually falls off after you get 20% equity in the property. Well, that's where there's a big difference with FHA, because FHA, if you're putting less than 10% down, that mortgage insurance is going to stay on that loan for the life of the loan, regardless if you have 20% equity, 30, 40, 50% equity. Unless you refinance out of that FHA loan, you're going to have the mortgage insurance on that loan. Now, if you put 10% or more down, that mortgage insurance will fall off after year 11. So after you've made payments for 11 straight years, that mortgage insurance will actually fall off the loan, assuming you haven't refinanced into another loan prior to that. But on top of that monthly mortgage insurance, there's also something called upfront mortgage insurance that's required on every single FHA loan. And this is required regardless of credit score, regardless of down payment, you're going to have that upfront mortgage insurance, and it's 1.75% of the loan amount. And I'm going to be talking about this here in just a minute, and I wanted to break it down before we go into the numbers to make sure you fully understand what it is. Now, with the upfront mortgage insurance, you can pay it out of pocket at closing, or you can finance it into the loan amount. Most people choose to finance it into the loan amount because that way you're coming up with less money out of pocket. But understand, because you're adding it back to the loan amount, you're actually losing part of the down payment that you put in that loan to start with. That 3.5% of equity essentially that you're putting into that property, you're going to lose about half of it because the upfront funding fee is 1.75%. But here's what I tell anyone that's kind of shying away from the upfront mortgage insurance or the monthly mortgage insurance. It's the cost of doing business. Unless you have 5, 10, 15% down, 20% down, and you can do another type of loan and avoid it, then you don't really have a choice. This is the best option out there. And I've had a lot of clients out there buy using FHA, and at some point they've been able to get equity in the property, they've been able to pay down the principal, and they've been able to refinance or get into another loan. So don't look at it as something that's completely negative. Just look at it as a stepping stone, as an opportunity to get into a better loan in the future. Now, as I mentioned a moment ago, we're going to do 3 different salaries with this video. Now, the first salary we're going to do is $50,000, we're going to do $75,000, and we're going to do $100,000. Well, that's exactly what we're going to dive into right after you hit that thumbs up if you're finding any value in this video at all. If you like videos like this, you like content like this, do me a favor and consider subscribing to the channel. Now, before we can determine how much home you can actually afford, we need to understand debt to income ratio, how a lender uses it to help you qualify for a loan. The very first thing they do is they take your gross monthly income before any taxes come out. Yes, they use it before taxes come out. We know that you pay taxes. We know that you pay into a 401k. We know that maybe you have child support and alimony that come out of your check every month, but they're not going to use that net amount. They're going to use the gross to keep it equal across the board because different people have different exemptions, different things that come out of their check every month. So the easiest way to calculate it is to use the gross. So what they do is they take the gross monthly income, so in this case $50,000, they divide it by 12. That gives you $4,167. Now with that, the lender uses something called a debt to income ratio. It's your monthly debt versus how much income you make. So they take your debt, in this case your housing expenses, anything that shows up on your credit report, things like car payments, credit cards, student loans, all of those things are going to matter when determining your debt to income ratio. But you have something called a front end ratio and a back end ratio when it comes to debt to income. Your front end ratio is just the housing expenses, the things that are associated with the house that you're buying. In the case that we're talking today, you're going to have your principal and interest payment, your mortgage payment. You're going to have property taxes. You're going to have homeowners insurance, and you're also going to have monthly mortgage insurance. Now, you might buy in a community that has an HOA. That also has to be factored into these numbers. But for our example today, we're saying a single family home. We're not talking HOA here with these numbers, and we're not going to calculate the debt up front. We're going to calculate it on the back end just so that you can see how these numbers work to determine whether or not you qualify. Now with that, on a $50,000 income or a $4,167 monthly income, your front end ratio cannot exceed $1,958. That's your housing expenses. Now with that, you can have about $417 of debt and still qualify for this loan because your back end ratio consists of the housing expenses plus any debts that show up on your credit report, things like car payments, student loans, credit cards, anything where you applied for credit to get it that shows up on your credit, that stuff has to be factored in to your debt to income ratio. So in this case, on a $50,000 income, your front end ratio can't be more than $1,958 and your back end ratio cannot exceed $2,375. So the very first purchase price I want to start with is a $250,000 purchase price. Can you buy that if you make $50,000 of income? Well, let's see. It's going to require a 3.5% down payment. So in this case, that's $8,750. But remember, you're going to have that upfront mortgage insurance premium that FHA requires on every single transaction. Remember, regardless of your credit score, regardless of your down payment, you're going to have this upfront mortgage insurance premium. So in this case of that 1.75%, that means you're adding back $4,222 and you're actually going to be financing $245,471. Now, once we have your base loan amount, we use today's interest rate, which is 5% on an FHA loan, which is going to give you a principal and interest payment of $1,318. Now, on top of that, you're going to have property taxes. I like to use the nationwide average at 1.1%. Now, if you're in a state that has higher property taxes like Texas, like New York, some of these states you're going to have to adjust accordingly when you're doing these formulas. But at 1.1%, that's $229 per month. In addition to that, you're going to have homeowners insurance. I'm estimating it roughly $100 a month. That's probably on the high side, but that's what we're going to use for today's video. And the last thing that we're going to factor in is our monthly mortgage insurance. Because we're putting less than 20% down, as we discussed earlier, you're going to have monthly mortgage insurance on this property. And how they determine this is they do 0.55% of your loan amount, which in this case is going to be $112 per month. So all in, your mortgage payment is $1,759 on this $250,000 home. Now, if you remember earlier, our front end ratio could not exceed $1,958. In this case, it doesn't exceed it. It's below it, which means we should be able to qualify for a $250,000 home if we make just $50,000 of income. But here's the caveat. Your debt cannot exceed $616 per month in order to qualify for this home, because otherwise you're not meeting that back-end ratio requirement at 57%. So we know you can qualify for $250,000, but can you qualify for $300,000? Well, at $300,000, the total mortgage payment doing the same calculations that we just did is $2,141, which actually exceeds that front end ratio of $1,958. So in this case, we know that you're going to qualify somewhere between $200,000 and $275,000 with a $50,000 income. But what about $75,000? Well, $75,000 of income breaks down to $6,250 a month, which means our front end ratio cannot exceed $2,938 and our back end ratio cannot exceed $3,563. So we know we could qualify for the $300,000, the $250,000 that we did earlier, but could we actually qualify for a $400,000 home? Well, the $400,000 home is going to require a down payment of $14,000, but you're also going to have that upfront mortgage insurance premium added back in, which means you're going to finance $392,755. If we're using today's interest rates at 5%, that's going to give you a mortgage payment of $2,108. We're also going to have those property taxes at 1.1%. That's going to be $367. In addition to homeowners insurance, I'm also estimating again at $100. And then our monthly mortgage insurance at 0.55% is going to be $180. So all in, our total mortgage payment at that $400,000 purchase price is $2,755 per month, which, if you remember from a moment ago, is actually below the threshold that we needed to stay under of $2,938. So at $75,000 of income, you should be able to qualify for a $400,000 home, assuming you don't have more than $808 of monthly debt. Because if you have more than $808 of monthly debt, you're going to exceed that back end ratio. Because remember, the front end ratio is just our housing expenses. The back end ratio is housing plus any of those other monthly debts. So you can meet the front end ratio and not meet the back end ratio and not qualify. And that's why it's very, very important to make sure you're working with a professional. If we can help, we would love the opportunity. There's a link in the description of this video. Now, as we bump up the purchase price to $450,000, that's going to give us a total mortgage payment using those same calculations at $3,087 a month. Now, if you remember, that's going to exceed our front end ratio of $2,938 $438, which means we're not going to be able to qualify with just $75,000 of income. But there's a chance we could be closer to $425. So reality is you're going to be somewhere between $400,000 and $425,000 on a purchase price, depending on how much debt you have. Now, the very last income I want to do is $100,000 of income. That breaks down to $8,333 a month, giving us a front-end ratio max of $3,917 and a back-end ratio max of $4,750. So why don't we just jump all the way to $550,000 to see if we can qualify for that much home, putting just 3.5% down? Well, in the case of $550,000, 3.5% down is $19,250. But remember, we have to add back in that upfront mortgage insurance premium of 1.75%, which in this case is $9,288, giving us a total base loan amount of $540,038. At a 5% interest rate, that's going to give us a mortgage payment of $2,899 per month. On top of that, we're going to have $504 for property taxes, in addition to $150 estimated for property insurance. And lastly, we're going to have that monthly mortgage insurance at $247 per month, which gives us a total monthly mortgage payment of $3,801 per month, which is actually below the threshold that we had to stay under of $3,917. So in the case of a $100,000 salary, you could qualify for a $550,000 home, assuming you didn't have more than $949 of monthly debt. But here's the thing. As I've talked about earlier in this video, make sure you're working with a professional. Don't do these calculations on your own, at home, on the back of the napkin, and then run out and try to buy a house without actually talking to a lender. Have a lender verify your income, look at your credit, look at all of these things, and actually make sure you're qualified to buy a home, because these calculations aren't meant to pre-approve you. They're meant to give you an idea of how much you can actually afford before talking to a lender. But it's imperative that you talk to a lender before you go out and start shopping. Now, with that, if you don't know where to start, you'd like to work with our team, I've actually put a link on the bottom of the screen and in the description of this video where you can get in touch directly with us and we can guide you through that process. But at the same time, remember, there's other guidelines on top of down payment and credit score. There's also things like property type, occupancy type, all of these things that you need to qualify for in order to use an FHA loan. If you're interested in determining whether or not you qualify for an FHA loan and meet all of the guidelines, do me a favor and check out this video here.